Before we begin, please note that I am not a licensed financial advisor or insurance professional. The information provided in this video is for educational and informational purposes only and should not be considered financial or legal advice. You should always consult with a qualified professional before making any decisions about your insurance coverage. Your financial situation is unique, and the strategies discussed here may not be suitable for everyone. You get the bill in the mail, or maybe it's an email notification that pops up on your phone. Your heart sinks just a little. You know what it is? It's your auto insurance renewal. You click it open and there it is. Your rate went up. Again. Not by a lot, maybe just 20 or 30 bucks a month, but it went up. And you start racking your brain. Did I get a ticket? No. An accident? No. Did I buy a new Lamborghini? Definitely not. So why are you paying more? Feels arbitrary. Feels unfair. It feels like you're being punished for absolutely no reason, trapped by a number handed down from a faceless corporation. That feeling of being powerless, of just accepting that this is a cost you can't control, that ends today. Right here in this presentation, I'm going to give you back the keys. We're not just going to talk about saving a few dollars. We're going to dismantle the system the insurance industry uses piece by piece so you can understand the game and finally play it to win. I'm going to give you 5 proven battle-tested strategies that have saved people, real people just like you, hundreds and in some cases over $1,000 a year on their car insurance. This isn't about finding some obscure loophole. This is about understanding the psychology, the data, and the hidden rules that determine your rate. By the end of this, you won't just have a lower bill. You'll have the confidence and the knowledge to ensure you never overpay for car insurance again. So let's get straight to it. The very first strategy is the most important, because it's the one built on a lie the insurance industry has been telling you for decades. The strategy is this: you must destroy the myth of the loyalty discount. You've heard it before. Bundle and save. Stay with us and get rewarded. They sell you this idea that being a long-term loyal customer is a virtue that will be repaid with better rates. That is, without a doubt, one of the most profitable deceptions in modern business. In the industry, they have a name for the opposite, and they don't like to talk about it. It's called price optimization, or more bluntly, the loyalty penalty. Here's how it works. Insurance companies are masters of data. They have mountains of it, and that data tells them something very simple. The longer a customer stays with them without shopping around, the less likely they are to leave in the future, even if their rates creep up. They know you're busy. They know you hate the hassle of getting new quotes. They know you think, oh, it's only an extra $15 a month. So they test you. They'll raise your rate by 4% at one renewal, then 5% at the next. They're walking a tightrope, trying to find the absolute maximum price you are willing to pay before you finally snap. They are banking on your inertia. Your loyalty isn't being rewarded. It's being monetized. It's being taken advantage of. Think about your cable or internet provider. A new customer gets a fantastic introductory offer, right? $49.99 a month for lightning-fast internet. But after a year, that same plan quietly jumps to $80. The company is betting that you, the existing customer, won't go through the trouble of canceling and switching to their competitor, who is, ironically, offering that same great intro rate. The auto insurance industry perfected this model. They are actively penalizing you for being a good, stable, and predictable customer. Let me tell you about Sarah, a nurse from Ohio. For 12 years, she was with the same big-name insurance company. She had a perfect driving record, never filed a claim, not even a parking ticket. She paid her bill on time every single time. She was the perfect customer. Her rate for 2 cars was about $1,800 a year. She thought that was reasonable. It had gone up a little each year, but it seemed normal. One day, her coworker mentioned he just switched insurers and saved $600. Sarah was skeptical. She thought, I've been with my company for over a decade. I must be getting the best deal they offer. But that night, curiosity got the better of her. She spent 45 minutes online putting her exact same information, same cars, same coverage, same address, into 3 different online quote tools. The first quote came back, $1,400 a year, a savings of $400. Not bad. The second quote, $1,250 a year. Now she was sitting up straight. The third quote came back from a company she'd heard of but never considered. The premium for the same coverage? $980 a year. Sarah stared at the screen in disbelief. She was paying over $800 more per year for 12 years of loyalty. That's nearly $10,000 she had lit on fire, simply because she trusted that her loyalty was being rewarded. She called her current insurer the next day, quote in hand. She said, "I've been a customer for 12 years, perfect record, and I have a quote here for almost half of what you're charging me. Can you match it?" The agent on the phone was polite, put her on hold and came back with a new offer. They could lower her rate by $150. Not $800, just $150. It was an insult. It was the clearest possible signal that her 12 years of loyalty meant absolutely nothing compared to their pricing algorithm. She switched that day and never looked back. Sarah's story isn't an exception, it is the rule. So what's the actionable strategy here? It's simple, but you have to treat it like a law. You must shop for new auto insurance every single year. Period. No excuses. I want you to take out your phone right now. Go to your calendar. Go to the date 1 month before your current policy is set to renew, and create a recurring annual event. Title it, "Shop for Car Insurance and Save Hundreds." Set a reminder for it. This is not optional. This is not something to do if you have time. This is a non-negotiable annual financial checkup, just like doing your taxes or going to the dentist. Spending 1 hour once a year is the single highest paying hourly job you will ever have. If you spend 1 hour and save $500, you just made $500 an hour. Not even top surgeons make that kind of money. The insurance companies have built a multi-billion-dollar empire on the assumption that you are too busy or too complacent to make that 1 hour investment. By committing to shopping your rate every year, you are breaking their model. You are telling the entire industry that you are an active, educated consumer, not a passive source of profit. You are putting them on notice. You are taking back control. This single act of annually comparing rates is the foundation of everything else we're going to talk about. It is the master key that unlocks every other savings strategy. But simply shopping isn't enough. You have to know what to look for, and how to make your profile as attractive as possible to a new insurer. Because what if I told you that a secret 3-digit number, and no, it's not your FICO credit score, is being used right now to dramatically inflate your insurance premiums, and most people have no idea it even exists. We're going to expose exactly what that number is and how you can change it. That number is called your auto insurance score, and it's the single biggest reason you're overpaying for car insurance. It's a controversial behind-the-scenes rating that insurers assign to you, and it has almost nothing to do with how you actually drive. Instead, it's based almost entirely on your credit history. Insurers will tell you that decades of data show a statistical correlation, not a causation but a correlation, between how a person manages their finances and how likely they are to get into an accident. In their eyes, someone who occasionally misses a credit card payment is, statistically speaking, a bigger risk on the road than someone who doesn't. Does that sound fair to you? To most people, it sounds completely insane. You could have a spotless driving record, 0 accidents, 0 tickets, and still be charged hundreds, even thousands of dollars more per year than a neighbor with the exact same car and a worse driving record, simply because their financial history looks better on paper. This isn't your FICO score, which lenders use. This is a separate, specialized score, calculated using a proprietary algorithm that pulls information from your credit report, things like your payment history, how much debt you carry, how long you've had credit, and if you've recently applied for new loans. The score typically ranges from 200 to 997, and the lower your score, the higher your premium. It's a silent killer for your wallet, operating in the shadows. But here's the good news. This brings us to our very first proven strategy for lowering your auto insurance. Take control of your auto insurance score. Since you now know this secret number exists, you can stop being a victim of it and start actively managing it. And the steps to do this are far simpler than you might think. First, you need to understand what's in your file. You have a legal right to see the information companies are using to judge you. The two big players in this space are LexisNexis and Verisk. You can go to the LexisNexis website and request a free copy of your CLUE report. That stands for Comprehensive Loss Underwriting Exchange. This report shows your auto insurance claim history for the past 7 years. Insurers are looking at this. You should too. Check it for errors. An accident that wasn't your fault could be listed incorrectly, or an old claim could still be haunting you. Disputing and correcting these errors is your first line of attack. But the real game is played with your credit report, because that's the primary fuel for your auto insurance score. You need to get your free credit reports from all 3 major bureaus, Equifax, Experian, and TransUnion. You can do this through the official government-mandated site, annualcreditreport.com. Don't go to the other sites with catchy jingles. They're designed to sell you things. The official one is free and safe. Once you have your reports, you're going to act like a detective. You're looking for the 5 key factors that build or destroy your score. Number 1, and this is the absolute king, payment history. This accounts for about 40% of your score. It's simple. Do you pay your bills on time? One single late payment reported to the credit bureaus can tank your score and directly lead to a higher insurance premium at your next renewal. The fix? Automate everything. Right now. Set up automatic payments for your credit cards, your student loan, your car payment, everything. Even if it's just the minimum payment, make sure it's never ever late. Think of it this way. Setting up autopay could be the most profitable 5 minutes you spend all year, saving you hundreds on insurance. Number 2, credit utilization. This is the second most important factor, making up about 30% of your score. And this is where most people get it wrong. You've probably heard you should keep your credit card balances below 30% of your limit. That's okay advice, but if you want the lowest insurance rates, okay, isn't good enough. The people with the highest scores, the ones getting the rock-bottom insurance premiums, keep their utilization under 10%. If you have a credit card with a $10,000 limit, you should never have a statement balance of more than $1,000. But here's an insider trick most people don't know. The credit card companies typically only report your balance to the credit bureaus once a month, on your statement closing date. This means you could use your card, pay it off in full before the statement date, and the bureaus will see a balance of 0. You get all the rewards and benefits of using the card, but for the purpose of your score, it looks like you're using none of your available credit. This single tactic can cause a massive rapid jump in your score. Start paying your balance a few days before the statement closes, not just before the due date. Number 3, length of credit history. This is about 15% of your score. Insurers like to see a long, stable history of managing credit responsibly. This is why the worst thing you can do is close your oldest credit card account. Even if you don't use it anymore, keep it open. Put a small, recurring charge on it like a Netflix subscription, and set up autopay to pay it off each month. That keeps the account active and preserves the age of your credit history, which directly helps your insurance score. Number 4, new credit. This is about 10% of your score. Every time you apply for a new credit card, a car loan, or a mortgage, it generates a hard inquiry on your report. A few of these are fine, but if you're applying for a new store card every time you check out just to save 15%, you're shooting yourself in the foot. It makes you look desperate for credit, which insurance companies see as a sign of financial instability and therefore higher risk. The lesson is simple. Only apply for credit when you actually need it. And finally, number 5, credit mix. This is the last 10%. Lenders and insurers like to see that you can handle different types of debt, like a mortgage, an auto loan, and credit cards. This is the least important factor, and you should absolutely not go out and get a loan you don't need just to improve your mix. It's something that will develop naturally over time. Focus on the big ones, paying on time and keeping your balances low. By actively managing these 5 factors, you are no longer just improving your credit, you are directly lowering your auto insurance score. You are taking back control from a secret system designed to charge you more. Do this for a few months and the impact can be dramatic. Now you might be thinking, this is great, but I live in California, or Hawaii, or Massachusetts. And you'd be right to ask. Those states have banned or severely restricted the use of credit-based information in setting auto insurance rates. So if you live there, this specific strategy won't have the same massive impact. But for the vast majority of Americans, this is the hidden battleground where the war over your insurance rates is won or lost. And even if you live in one of those states, having excellent credit helps in so many other areas of your life that these are habits worth building anyway. But fixing your insurance score is just the first piece of the puzzle. It's a powerful foundational step. But what if your credit is already perfect? Or what if you need to lower your bill right now, not in 6 months? There is another strategy, one that has nothing to do with your credit. It's a change you can make today in the next 15 minutes that could slash your premium by 20, 30, or even 50% instantly. It involves something called deductibles. And the choice you make here reveals everything about how you think about risk. And insurance companies are banking on the fact that you're thinking about it all wrong. What if I told you that selecting a higher number could paradoxically be the safest financial decision you could ever make? Sounds counterintuitive, but the math is undeniable. and we're about to break it down step by step. Let's start with the first, and arguably the most impactful strategy, a concept I call mastering the deductible game. It's a fundamental shift in how you view the very purpose of insurance. Most people see their auto insurance as a safety net for any and every little thing that could go wrong. A scratched bumper, a cracked taillight, a minor fender bender in a parking lot. And because of this, they gravitate towards the lowest possible deductible. $250, $500. Feels safe, right? Feels responsible. The idea of having to pay $1,000 or even $1,500 out of pocket after an accident is terrifying. So we pay more month after month, year after year, for the peace of mind that comes with a low number on that one line of our policy. But this peace of mind is an illusion. It's a costly, financially draining illusion that insurance companies are more than happy for you to buy into. Because here's the brutal truth they don't advertise. Your car insurance is not meant for small claims. It is not a maintenance plan. It is a financial shield against catastrophe. It's there to protect you from a $60,000 medical bill or a lawsuit that could wipe out your life savings. It is not there for an $800 bumper repair. Let me paint you a picture. Let's invent two drivers, we'll call them Mark and David. They're neighbors. They drive similar cars, have similar driving records, live on the same street. They are, for insurance purposes, identical twins. But they make one critically different choice. Mark is a cautious guy. He thinks, I don't want to be on the hook for a big bill if something happens. So he chooses a low, safe $250 deductible. His insurance company loves this. They quote him a premium of $150 per month. That's $1,800 a year. Mark feels secure. He feels protected. David, on the other hand, has listened to this video. He understands the game. He decides to play it differently. He opts for a $1,000 deductible. The insurance company sees him as less of a risk for small, annoying claims. Their quote for him? Only $100 per month. That's $1,200 a year. Right off the bat, David is saving $50 every single month. $600 a year. That's real money. That's a weekend trip, a new set of tires, a big chunk of a holiday gift budget. But the real test comes when something actually happens. One afternoon, they both have a bit of bad luck. Mark is backing out of a parking spot and misjudges the distance to a pole. Crunch. It's not a disaster, but it's a nasty dent and a cracked bumper. He takes it to the shop. The estimate comes back. $900. Phew, Mark thinks. Good thing I have that low deductible. He files a claim, pays his $250, and the insurance company covers the remaining $650. He feels like his policy just paid for itself. He won. A week later, David has the exact same bad luck. Same pole, same crunch, same $900 repair estimate. But David's calculation is completely different. His deductible is $1,000. The repair cost is less than his deductible. Filing a claim is pointless. The insurance company wouldn't pay a dime anyway. So, he pays the $900 out of his own pocket. On the surface, it looks like Mark made the smarter choice. He's only out $250. David is out $900. Mark is the clear winner, right? Wrong. So wrong. What Mark doesn't see is the second half of the equation. The part that happens 6 months later. It's renewal time. Mark gets his new insurance bill in the mail. He opens it and his jaw hits the floor. His premium has jumped from $150 a month to $210 a month. That's a 40% increase. Why? Because he filed a claim. He is no longer seen as a claims-free driver. He now has an at-fault accident on his record, and that record follows him for 3 to 5 years. Let's do the math on Mark's win. His new premium is an extra $60 a month. That's an extra $720 per year. Over the next 3 years, that single small claim will cost him an additional $2,160 in higher premiums. Add that to the $250 deductible he already paid, and that $900 accident has now cost him a staggering $2,410. He didn't win. He got played. Now let's look at David. His renewal notice arrives. His rate, it's exactly the same. Maybe it even went down a little. He never filed a claim, so his record is still spotless. He's still considered a safe, low-risk driver. He paid the $900 out of pocket, and that was the end of it. The incident was over and done. But let's not forget the best part. For the entire year leading up to that accident, David was already saving $600 on his premiums compared to Mark. So his net cost for that accident wasn't really $900. It was $900 minus the $600 he had already saved. His true out-of-pocket cost was only $300. He paid $300 for the repair, kept his record clean, and prevented his rates from skyrocketing for the next 3 years. Compared to Mark's total cost of over $2,400, David is the undisputed financial genius. Now I know what you're thinking, but what if the damage was more? What if it was a $5,000 accident? That's the fear talking. That's the voice that keeps you paying too much. And here is the solution. This is the actionable step that makes this entire strategy foolproof. The moment you make the switch, the day you call your agent and say, "Raise my deductible to $1,000, you take the money you save and you put it away. David saved $50 a month. He should take that $50 and transfer it automatically into a separate high-yield savings account, an account he labels Deductible Fund. In just 20 months, David's $50 monthly savings will have grown to $1,000, plus a little interest. He has now used the insurance company's own money to completely self-insure his deductible. He has completely eliminated the risk. From that point forward, every $50 he saves each month is pure profit straight into his pocket forever. He has beaten the system. You need to change your mindset. A higher deductible is not a risk. It is a calculated strategy. You are making a bet on yourself. And the statistics are overwhelmingly on your side. The average American driver files a claim only once every 17.9 years. Think about that. You are paying a premium, a literal penalty, every single month for an event that might happen once every 2 decades. By choosing a higher deductible, you are telling the insurance company, "I'll handle the small stuff. I'm a responsible driver. I only need you for the giant, life-altering disasters." And they will reward you for it with a dramatically lower rate. You stop being a source of frequent, low-value, high-hassle claims for them, and you start becoming the ideal, profitable, low-maintenance customer they want. So I want you to do this. After this video, pull up your insurance policy, find your deductible, and ask yourself one question. How much have I paid in extra premiums over the last 5 years just to keep that number low? Has it been worth it? Now, imagine what you could have done with that money instead. Raising your deductible is the single fastest way to slash your auto insurance bill. It's a conscious choice to manage your own risk for minor incidents in exchange for massive long-term savings. It's the difference between being a pawn in the insurance game and being the one who controls the board. But this is just the first move. Once you've set your deductible correctly, we have to look at the second hidden factor that could be costing you a fortune. It has nothing to do with how you drive and everything to do with what you drive. And it's not what you think. It's not about driving a sports car versus a minivan. There's a much more subtle, almost invisible characteristic of your vehicle that insurance companies are using to charge you hundreds, if not thousands, of extra dollars a year. And in the next part, we're going to expose exactly what it is and how you can use that knowledge to your advantage. That one single characteristic is your car's secret identity. It's not just the make and model. It's what insurance companies call its loss history. This is a data-driven profile of your exact year, make, and model, tracking 2 crucial things: how often it's stolen and how much it costs to fix after a crash. You might have a perfect driving record, but if you own a car that's a magnet for thieves or has ridiculously expensive parts, you are subsidizing the risk for every other person who owns that same car. You are being penalized for a decision you made in the dealership maybe years ago without ever knowing the consequences. Let me tell you a story that perfectly illustrates this. It's the story of the Kia and Hyundai disaster. Starting around 2015, and for years after, millions of Kias and Hyundais were sold in the United States without a critical, inexpensive piece of technology called an engine immobilizer. An immobilizer is a basic anti-theft device that prevents the engine from starting unless the correct key is present. Most other car makers had been including them as standard for years, but on these specific models it was missing. For a while, nobody really noticed. Then, a few years ago, a group of thieves in Milwaukee discovered this vulnerability. They figured out you could break the steering column, pop off the ignition cylinder, and start the car with nothing more than a screwdriver and a standard USB cable. A USB cable, the kind you use to charge your phone. This discovery didn't stay a local secret. It exploded on social media, particularly TikTok. It became a viral challenge, a game. They called themselves the Kia Boys. Videos spread like wildfire showing teenagers how to steal these cars in under 60 seconds. The result was a nationwide catastrophe. In some cities, thefts of Kias and Hyundais surged by over 1,000%. 1,000. These weren't professional car thieves shipping cars overseas. These were kids going on joyrides, crashing them and abandoning them. Now imagine you're a responsible Kia owner. You park in a safe garage, you have a perfect driving record, you've never even had a speeding ticket. You did nothing wrong. But suddenly you get your insurance renewal notice, and your premium has doubled. Or tripled. Or worse, you get a letter saying your insurance company is dropping you altogether. They will no longer insure your car, period. Why? Because from the insurance company's perspective, you're not just you anymore. You are the owner of a high-risk asset. They aren't just insuring against your driving. They have to insure against the risk that any teenager with a phone and a USB cable can steal your car from the grocery store parking lot. The data was screaming at them. Their comprehensive claims, the part of your policy that covers theft, were going through the roof. They were losing millions of dollars. So, they passed that cost directly on to every single person who owned one of those cars. The good drivers paid the price for the bad actors and a manufacturer's cost-cutting decision. This isn't just a wild story about Kias. This exact same principle applies in a less dramatic way to every single car on the road. Insurance companies and organizations like the Highway Loss Data Institute maintain massive databases. They know exactly which model of pickup truck is the most stolen in Texas. They know that the advanced sensors and cameras in the bumper of a new Toyota might cost $5,000 to replace after a minor fender bender, while the bumper on an older Ford might cost $500. They know that the catalytic converter on a Prius is packed with precious metals and is a prime target for thieves. They know all of this, but most of us don't. We walk onto a car lot and see two similar-looking SUVs. They have similar price tags, similar gas mileage, similar features. We pick one based on the color or the cup holders. What we don't see is the invisible price tag, the insurance liability. One of those SUVs might be statistically safer, less likely to be stolen, and cheaper to repair, making it hundreds of dollars a year cheaper to insure. The other might be a hidden money pit, not because of its maintenance but because of its insurance profile. And this brings us to our second proven strategy, which is perhaps the most powerful and most overlooked money-saving tactic of all. Shop for insurance before you shop for a car. Most people do this completely backward. They spend weeks, even months, researching the perfect car. They read reviews, they test drive, they negotiate fiercely with the dealer to save $1,000 off the sticker price. They finally sign the papers, get the keys, and feel that rush of victory. Then, as an afterthought, they call their insurance company to add the new car to their policy. And that's when the hammer drops. The agent says, "Okay, your new monthly premium will be $350. And their heart sinks. All the money they fought so hard to save at the dealership is now being handed over to the insurance company, month after month, for the next 5 years. You must flip the script. Your insurance cost is a non-negotiable part of your car's total cost of ownership, just like your car payment and your gas. You need to know that number before you ever commit to the vehicle. Here's the exact process. Let's say you're in the market for a used midsize sedan. You've narrowed it down to 3 possibilities: a Honda Accord, a Toyota Camry, and a Nissan Altima. Before you even step foot in a dealership, go online to a site like cars.com or AutoTrader. You don't need to find the exact car you're going to buy. You just need to find 3 listings for the year and trim level you're considering. The goal is to get a real vehicle identification number, or VIN, for each of them. The VIN is the 17-digit code that uniquely identifies that specific vehicle. Now, armed with those 3 VINs, you go to a comparison website or call your insurance agent. You say, "I'm thinking of buying one of 3 cars and I'd like a quote for each." You give them the VIN for the Accord. You get a quote. Then the Camry. You get a quote. Then the Altima. You get a quote. The results might shock you. You might find the Accord costs $120 a month. The Camry, which you thought would be identical, is $145 a month. And the Altima comes in at $180 a month. Why? Maybe the Altima has a higher theft rate in your zip code. Maybe the Camry's parts are slightly more expensive. The reasons don't matter as much as the result. The Altima would cost you an extra $60 a month, or $720 a year, or $3,600 over a 5-year loan, compared to the Accord. That's a massive difference. That knowledge is power. Now you can walk into the dealership informed. You can look at two cars with the same sticker price and know that one is secretly thousands of dollars more expensive than the other. This isn't just for used cars. If you're buying new, you can still do this. Just tell the insurance agent the exact year, make, and model, and they can run a very accurate quote without a VIN. By doing this, you are front-loading the financial pain. You are discovering the true cost of the car before you get emotionally attached to it. You are turning an emotional decision into a purely financial one. You're not just buying a car, you're buying a transportation budget. And failing to research the insurance costs first is like agreeing to a mortgage without knowing the property taxes. It's financial malpractice. So you've now learned how to use your personal profile to your advantage, and you know how to choose a car that insurance companies secretly love. You've already tackled two of the biggest variables. But there's another layer to this. What if you've done everything right, you have a great record, you chose a low-risk car, but you're still paying too much? It's possible that the problem isn't you, and it isn't your car. The problem is the company you're trying to buy from. You could be calling the completely wrong type of insurance provider, a mistake that locks you into a higher price before you even get the quote. There are different kinds of insurance sellers, and they operate on fundamentally different business models. One is designed to give you options, the other is designed to give you theirs. In the next part, we'll reveal this critical difference and show you how to exploit their structure to find the lowest possible price. So let's pull back the curtain on this critical difference. On one side of the ring, you have what's called a captive agent. And on the other, you have an independent agent or a broker. To you, the consumer, they might look identical. They have an office, a friendly smile, and a promise to save you money. But underneath the surface, their entire world, their motivation, their very reason for existing, is fundamentally different. And understanding this difference is the key to unlocking hundreds, if not thousands of dollars in savings. A captive agent works for one and only one insurance company. Think of the big names you see advertised during the Super Bowl, the State Farms, the Allstates, the Farmers of the world. The agents with those logos on their doors are employees or exclusive contractors for that single brand. Their job is to sell you that brand's products. They are experts on their company's policies, their specific discounts, and their unique coverage options. They are, in essence, a specialist in a single product line. Now, think about an independent agent or broker. They don't work for an insurance company. They work for you. An independent agent represents dozens, sometimes even hundreds of different insurance companies. They are not tied to any single brand. Their job is to take your specific situation, your car, your driving record, your family's needs, and shop it across their entire network of carriers to find the best possible combination of coverage and price. Let me put it this way. A captive agent is like an employee at a Nike store. You can walk in and ask for the best running shoe, and they will passionately and knowledgeably show you the absolute best Nike shoe for your needs. But if the perfect shoe for you is actually made by Adidas, they can't sell it to you. In fact, they might not even know it exists. Their entire universe is Nike. An independent agent, on the other hand, is like a professional personal shopper. You tell them you need a running shoe, and they go to the Nike store, the Adidas store, the New Balance store, and the Brooks store. They compare all the options, weigh the pros and cons of each, and come back to you not with the best shoe from one brand, but with the absolute best shoe for you, period. This is the game. One is a salesperson for a single manufacturer. The other is a marketplace consultant. One business model is designed to keep you within their ecosystem. The other is designed to survey the entire landscape. By choosing to work with an independent agent, you are instantly multiplying your quoting power by 10, 20, or even 50 times without doing any of the extra work yourself. You are leveraging their network, their expertise, and their technology to force dozens of companies to compete for your business. Let's make this real. Meet Sarah, a 35-year-old nurse with a clean driving record, a reliable 2018 Honda CR-V, and a recent move to a new zip code. Her renewal with her longtime big brand insurer came in the mail, and the price had jumped by 30%. No accidents, no tickets, just a mysterious, frustrating increase. So Sarah did what her parents always did. She called another famous big brand captive agent she saw on a billboard every day. The agent was nice, professional, and ran her information. He came back with a quote that was okay. It was about 10% lower than her renewal, which felt like a small victory. He explained all the discounts she qualified for with his company and showed her how their mobile app was top of the line. Sarah was about to switch, saving a modest $20 a month, figuring that was the best she could do. But then she remembered a piece of advice. Before signing, she decided to try one more option. She did a quick search for independent auto insurance agent near me. She found a local office with great reviews and gave them a call. The experience was completely different. The independent agent, a guy named Mike, didn't start by talking about his company. He started by talking about her. He asked about her commute, if she had a garage, her credit score range, and even her profession, noting that some carriers offered discounts for nurses. He took all her information down once. Then he said, "Okay, Sarah, give me about an hour. I'm going to shop this with the 27 different carriers I work with and see who wants your business the most." An hour later, Mike called back. He didn't have one quote. He had three. The best quote was from a highly rated, A-plus insurance company Sarah had barely heard of. Maybe she'd seen their logo on a race car once. The price wasn't 10% lower than her renewal. It was 45% lower. It was nearly half of what she was currently paying. The coverage was identical, with even a slightly lower deductible on her comprehensive. The second best quote was still 30% lower. The third was comparable to the quote the captive agent gave her. Sarah was stunned. She had spent years with her trusted big brand company, assuming her loyalty was being rewarded. She almost switched to another big brand, thinking a 10% savings was a good deal. But in 1 hour, an independent agent did what she never could have done on her own. He made nearly 30 companies bid against each other for her policy. He found a carrier that specifically valued a driver profile just like hers. A nurse with a clean record and a safe, reliable car in her particular zip code. The big brand she knew saw her as just another number in their massive system. This other company saw her as a perfect, low-risk customer and priced her policy accordingly. This is how you exploit the structure of the industry. You're not cheating. You are simply choosing to play the game on the field that gives you the most options. You are stepping out of the single-brand showroom and into the sprawling, competitive super mall of insurance. So, how do you find your Mike? Simpler than you think. First, go to your search engine of choice and type in independent insurance agent, plus your city or zip code. You'll see local agencies pop up. But here's a pro tip. Look for an agent who is part of a network like Trusted Choice, or the Independent Insurance Agents and Brokers of America, IIABA. These are networks of vetted, professional independent agents, which adds a layer of credibility. Second, when you call them, your goal is to interview them just as much as they are interviewing you. Don't be afraid to ask, how many insurance carriers do you represent? If the answer is just a handful, like 3 or 4, they might be what's called a limited agent. You want someone with a broad portfolio, ideally 10 or more. The more carriers, the more competitive the marketplace they can create for you. Third, ask them which carriers they think will be the most competitive for your specific profile before they run the quotes. A great agent will know their markets. They might say something like, based on your car and your clean record, I think Progressive, Travelers, and Safeco are going to be our top contenders, but I'll check everyone. This shows they have a strategy and deep industry knowledge, rather than just plugging your data into a machine and seeing what spits out. And finally, pay attention to the process. A good independent agent isn't just looking for the lowest number. They're a risk advisor. They should be asking you questions about your assets to make sure your liability limits are high enough. They should explain the difference between minimum coverage and smart coverage. If they just immediately push the cheapest possible option without any conversation, be wary. The goal is to find the best value, not just the lowest price tag. By making this one single shift, from seeking out a brand to seeking out a broker, you change the entire dynamic. You stop being a potential sale for a single company, and you become a valued client that multiple companies have to fight for. This is, without a doubt, one of the most powerful strategies for slashing your auto insurance bill. But finding the right broker is only half the battle. Because even the best broker in the world is working with a universe of insurance companies that are fundamentally different from one another. They fall into distinct categories with different appetites for risk, and they use a secret language of underwriting to decide if you're the kind of customer they even want. Understanding this language, knowing whether you fit better with a standard, non-standard, or preferred carrier, is the next layer of the onion. And in the next part, we're going to peel it back, revealing how matching your personal profile to the right type of insurance company can unlock a level of savings that even most agents won't tell you about. Okay, let's break this down. Think of the insurance industry not as one giant store, but as a street full of different shops. You have your high-end luxury boutiques, your big-box department stores, and your specialized outlet shops. If you need a cheap, reliable pair of work boots, you don't start your search at Saks Fifth Avenue. You'd be wasting your time and you'd get sticker shock. Auto insurance is exactly the same. The single biggest mistake people make is shopping at the wrong store for their specific needs. They hear a catchy jingle on TV and assume that company is for everyone. It's not. Every insurance carrier has a sweet spot, a target customer profile they've built their entire business model around. Their advertising, their pricing algorithms, their underwriting rules, everything is designed to attract and profitably insure a very specific type of driver. If you fall into that sweet spot, you get their best rates. If you don't, they'll either reject you outright or give you what's called a go-away price. A quote so ridiculously high it's their polite way of saying, "Please, we don't want your business." Your job isn't to find the one cheapest company. Your job is to find the company whose sweet spot is you. Broadly speaking, we can group these companies into three main categories. Understanding which category you belong in is the master key to unlocking the lowest possible rates. First, you have the preferred carriers. These are the luxury boutiques of the insurance world. Think companies like Amica, USAA, and sometimes regional gems like Erie Insurance. Their target customer is the A-plus student of the driving world. We're talking a credit score north of 750, a spotless driving record for at least 5 years, no accidents, no tickets, not even a parking violation they can see. This person is likely a homeowner, is probably married, and has a stable career. They are, from an insurer's perspective, the lowest possible risk. Because these companies are so selective about who they let in, they can maintain a very clean risk pool. This means their customers have fewer claims, which allows the company to offer incredibly low rates and often award-winning customer service. They don't need to spend billions on advertising because their business model is built on attracting and retaining the safest drivers who rarely cost them money. If you fit this profile, you absolutely must get a quote from a preferred carrier. Going with a standard company might mean you're leaving hundreds, even thousands of dollars on the table every year. But if you have a recent speeding ticket or a fender bender, don't even bother. You're not shopping in the right store. The second category, and the one most of us are familiar with, is the standard carriers. These are the big box department stores. Geico, Progressive, State Farm, Allstate, Liberty Mutual. Their sweet spot is the massive American middle. They are looking for good, but not necessarily perfect drivers. Maybe you have a single speeding ticket from 2 years ago. Maybe you had a small at-fault accident 3 years back. Your credit score might be good, but not flawless, say in the 680 to 740 range. You're a responsible person, but life happens. These companies have built sophisticated computer models to price for this level of moderate risk. They spend billions on advertising because they're competing for the largest segment of the population. This is where the majority of American drivers will find their best rates. These companies have a much wider appetite for risk than the preferred carriers. They won't slam the door in your face for a minor infraction. However, their rates are based on a pool of drivers that has more claims than a preferred pool, so their base rates will naturally be a bit higher. The key here is that within this standard market, different companies have different appetites. One company might be more forgiving of a speeding ticket, while another might penalize you more for credit score issues. That's why shopping among these giants is still critical. Finally, we have the third category, the non-standard carriers. These are the specialized outlet shops. Think of companies like the General, Safe Auto, or Dairyland. These companies don't just accept high-risk drivers, they actively seek them out. This is their entire business model. Their sweet spot includes drivers who might have a DUI or a DWI on their record, drivers who need in-state Route 22 filing to get their license back, people with multiple accidents and tickets, drivers with very poor credit, or those who have had a long lapse in their insurance coverage. Now, a lot of people look down on these companies, but they serve a critical purpose. If you're in this high-risk category, the preferred and even most standard carriers will simply refuse to insure you. The non-standard carriers are the ones who will give you a policy so you can legally drive to work and rebuild your record. Their rates will, of course, be significantly higher than the other two categories. That's just a reflection of the immense risk they're taking on. But here's the crucial point. For a driver with a DUI, the lowest rate isn't going to be from Geico. It's going to be from the non-standard specialist who can actually offer them a policy at the most competitive price for that specific high-risk profile. Going to the wrong type of company in this situation is the difference between getting a policy and not being able to drive at all. So how do you figure out where you fit? You have to be brutally honest with yourself. Pull your driving record. Know your real credit score, not just a guess. Look at your history with clear eyes. Let's imagine two friends, David and Sarah. David is 45, married, owns his home, has an 810 credit score, and hasn't had a ticket since he was a teenager. For years, he was with a big national standard carrier, paying a decent rate. But David is a preferred risk. He's the guy Amica was built for. When he finally got a quote from them, he saved over $1,000 a year because he was finally shopping in the store designed for him. Sarah, on the other hand, had a tough year. She was in an at-fault accident, and due to a job change, she let her insurance lapse for 45 days. Her previous preferred carrier non-renewed her policy. She was panicking. She started calling all the big standard names she saw on TV and was getting quoted astronomical numbers. She felt hopeless. The problem was that combination of an at-fault accident and a lapse in coverage instantly kicked her into the non-standard risk category, at least temporarily. The standard companies saw her as too risky. It wasn't until she spoke with an agent who specialized in the non-standard market that she found a manageable rate. It was more than she used to pay, yes, but it was half of what the standard companies were quoting her. She found the right store for her current situation. In a few years, after her record clears up, she can move back into the standard market, and eventually maybe even the preferred market. This is not about being a good or bad person. It's a cold, hard, data-driven business. The carriers are just sorting you into risk pools. Your mission is to correctly identify which pool you're in right now, and then focus all your energy on the companies that specialize in that pool. Stop wasting your time getting go away prices from companies that don't want your business. You're just driving yourself crazy and concluding that all insurance is a ripoff. It's not. You're just knocking on the wrong doors. By identifying your profile first, preferred, standard, or non-standard, you've done more to lower your insurance bill than 90% of the population. You've narrowed the field from hundreds of confusing options to a small handful of companies that are actually competing for you. But this brings up the next critical question. Now that you know what type of company to target, what is the best way to approach them? Do you go directly to their website? Do you call a captive agent who only works for one company? Or do you find an independent agent who can shop multiple carriers for you? Each path has powerful advantages and hidden pitfalls, and choosing the right one for your specific profile is the final strategic layer to guarantee you're not leaving a single dollar on the table. Let's dissect these 3 battle plans, starting with the one that feels the most modern, the most empowering, going direct to the carrier. This is the DIY approach. Your laptop, and the open road of the internet. You go straight to the websites of Geico, Progressive, Esurance, or any number of carriers who have spent billions of dollars to convince you that buying insurance is as easy as ordering a pizza. And in some ways, they're right. The biggest advantage here is control. You are in the driver's seat, literally and figuratively. You can tweak your coverage levels, add or remove options, and see the price change in real time. It's fast. You can get a dozen quotes in an hour if you're focused. There's no middleman, no agent trying to upsell you, no pressure. It's just you and the algorithm. For someone with a simple, straightforward profile, one car, one driver, a squeaky clean record, and a good understanding of what liability limits and deductibles actually mean, this can be an incredibly efficient way to shop. But this path is littered with hidden traps for the unwary. The illusion of control is a powerful one, but it can be dangerous. When you go direct, you are your own insurance advisor. The website isn't going to stop you and say, "Wait a minute, Bob. Are you sure those state minimum liability limits are enough to protect your house and your life savings if you cause a serious accident?" The website's goal is to close the sale. It will happily sell you a policy that meets the legal minimum, but might be catastrophically inadequate for your actual financial situation. You are responsible for understanding the fine print, the exclusions, the nuances between full coverage, and what that actually means. It's also incredibly time-consuming to do this right. Sure, you can get a dozen quotes in an hour, but did you quote the right dozen? There are hundreds of insurance carriers in the US. Many of them are fantastic regional players you've never even heard of that might offer an incredible rate for your specific zip code. You'll never find them with a simple Google search. You're only seeing the companies with the biggest advertising budgets. So while the direct approach offers speed and control, it demands a high level of personal expertise and a significant time investment to be truly effective. It's for the confident researcher who is willing to accept all the risk of being their own expert. Now let's pivot to the most traditional route, the captive agent. This is the person with an office on Main Street, their name on the sign representing one and only one brand. Think of your local State Farm, Allstate, or Farmers agent. The word captive sounds negative, but it doesn't have to be. The primary advantage of a captive agent is deep, specialized knowledge. These agents live and breathe their company's products. They know every single discount available, every loophole, every unique policy feature that company offers. They can tell you exactly how bundling your home and auto will impact your multi-line discount percentage, down to the penny. You're not dealing with a faceless website. You're building a relationship with a person. This person can become your trusted advisor, someone you can call directly when you have a question or, more importantly, when you have a claim. They can often advocate for you within the massive bureaucracy of the insurance company. They make the process personal. If you value brand loyalty and the peace of mind that comes from having a single point of contact who is an expert on your specific policies, the captive agent is a fantastic choice. However, the major, unavoidable pitfall is right there in the name: they are captive. Their loyalty is ultimately to the company that signs their paychecks. They cannot, under any circumstances, sell you a policy from a competitor. If another company across town could save you $600 a year with identical coverage, your captive agent is not going to tell you that. It's not that they're dishonest. It's simply not their job. Their job is to find you the best solution within their company's ecosystem. If that company takes a big rate increase in your state, which happens all the time, your agent's only options are to try and reshop you within their own system, maybe by raising your deductibles or lowering your coverage, or to simply deliver the bad news. They can't just pick up the phone and place your policy with a different, cheaper carrier. So you're trading market-wide price competition for deep product expertise and a personal relationship. It's like going to a Ford dealership. The salesperson can be the most knowledgeable, helpful person in the world, but at the end of the day, they're only going to sell you a Ford. They're not going to suggest you check out the new Honda down the street. This brings us to our third and, for many people, most powerful option: the independent agent. An independent agent or broker is the polar opposite of a captive agent. They don't work for an insurance company. They work for you. They are contracted with dozens, sometimes even hundreds of different insurance carriers. This is their superpower. When you go to an independent agent, you fill out one application, have one conversation, and they do all the heavy lifting. They take your specific profile, your cars, your driving history, your coverage needs, and they shop it across their entire network of carriers. They can compare a policy from Progressive to one from Travelers, to one from a smaller regional company like Erie or auto owners that you've never heard of but that happens to be incredibly competitive for drivers exactly like you. They are playing the entire field. Their primary goal isn't to sell you on a specific brand. It's to find you the best possible combination of coverage, service, and price. They can provide impartial advice, explaining why one company's policy might be slightly more expensive, but offers a critical coverage the cheaper one lacks. And here's the real kicker: they provide long-term value. If your current carrier jacks up your rates at renewal, your independent agent doesn't just give you the bad news. They proactively reshop your policy to find a better deal. They manage the relationship for you, ensuring you're always in a competitive position without you having to go through the quoting process all over again every year. So what's the catch? Why doesn't everyone use an independent agent? Well, there are a couple of things to be aware of. First, no independent agent has access to every single company. Some of the biggest direct-to-consumer players, like Geico, typically don't work with independent agents. So an independent agent can't quote them for you. Second, the quality of agents varies. A great independent agent is a priceless asset, a true partner in your financial life. A mediocre one might only shop a few of their favorite carriers and not do the comprehensive search you're hoping for. It requires a little bit of research to find a well-respected, highly reviewed independent agency in your area, but the potential upside is immense. You're outsourcing the most tedious and complex part of the insurance shopping process to a professional whose success is directly tied to your satisfaction. You are leveraging their expertise, their technology, and their market access for your own benefit. So we have three distinct strategies: the DIY expert going direct, the brand loyalist using a captive agent, and the savvy shopper partnering with an independent agent. Which one is definitively the best? The answer is a trick question. The ultimate, grandmaster strategy isn't to choose one. It's to create a hybrid approach that forces all of them to compete for your business. This is how you guarantee you see the entire landscape. Here's the play. First, you identify the major carriers that primarily sell direct. Go online and get quotes from Geico and Progressive yourself. Nail those down. You now have your direct-to-consumer baseline. Step 2, you contact a highly rated independent insurance agent in your area. You tell them, "Here's my situation. I need you to shop the market and find me the absolute best value you can." They will then go out and get quotes from all of their partner carriers. companies you couldn't easily access on your own. Now you have the best of both worlds. You have the best price from the massive direct advertisers, and you have the best price from the vast network of carriers that work through agents. You can then compare these top contenders side by side. Maybe Geico's direct price is the winner. Or maybe the independent agent found a hidden gem that blows everyone else out of the water. By using this hybrid method, you eliminate the blind spots inherent in any single approach. You're not just hoping you found the best rate. You're creating a system of competition that ensures the best rate finds you. This is no longer just about saving money. It's about taking command of the process, understanding the industry's structure, and using it to your maximum advantage. And this brings us to our fourth proven strategy, which is less of a single action and more of a mindset shift. You need to become a discount detective. Most people assume the quote they get is a fixed final number. They see it as a price tag on a shelf. This is a massive mistake. The initial quote is a starting point, a lump of clay. The discounts are the tools you use to sculpt it into something much, much smaller. Insurance companies have a whole menu of discounts, but they are not always going to offer them up on a silver platter. You have to ask. You have to hunt. You have to know they exist in the first place. Let's start with the most common ones, the ones you've probably heard of, but maybe haven't fully leveraged. There's the multi-policy discount, often called bundling. This is a big one. If you have homeowners or renters insurance, getting it from the same company as your auto insurance can often lead to savings of anywhere from 5 to 25% on both policies. It's the industry's version of a value meal. Then there's the multi-car discount. If you have more than one vehicle in your household, insuring them all with the same company is almost always cheaper than insuring them separately. These are the low-hanging fruit, but the tree is much, much bigger. Now let's dig deeper. Think about the driver. Are you a good student? Many insurers offer a good student discount that can be surprisingly substantial, often lasting until you're 25, as long as you maintain a B average or better. Did you take a defensive driving course? In many states, completing an approved course can knock a percentage off your premium for several years. It's a weekend of your time for potentially hundreds of dollars in savings. And what about your driving habits? This is where telematics comes in. Programs like Progressive Snapshot or State Farm's Drive Safe and Save use a smartphone app or a small device in your car to monitor your actual driving behavior. Things like hard braking, rapid acceleration, and the time of day you drive. If you're a genuinely safe driver, this can translate into a highly personalized discount based on your real-world actions, not just statistics about your demographic. It's the ultimate show don't tell way to prove you're a low risk. Next, think about your vehicle. The car itself is a treasure trove of potential discounts. Does it have anti-lock brakes, airbags, daytime running lights? These are standard on most new cars, but sometimes you still have to explicitly mention them to make sure you're getting the safety features discount. What about an anti-theft system? A passive alarm that arms itself automatically or a vehicle recovery system like LoJack can often shave a nice percentage off your comprehensive coverage. Even the type of car matters. Insuring a sensible family sedan will always be cheaper than insuring a high-performance sports car, not just because of its value, but because of its safety ratings and lower likelihood of being driven recklessly. But the real secret, the one that separates the amateurs from the pros in this game, lies in the affinity and group discounts. This is where you get rewarded for who you are and what you do. Are you a member of a certain profession? Many companies offer discounts for teachers, nurses, engineers, scientists, police officers, and firefighters. Are you active or retired military? Companies like USAA and Geico are famous for their military-focused discounts. Do you belong to a professional organization, a university alumni association, a credit union, or even a wholesale club like Costco? Many of these groups have negotiated special discounted rates with insurance carriers for their members. This is the one people miss most often. They just don't think to ask, do you have a discount for graduates of my university? Or, is there a discount for members of the American Society of Civil Engineers? You have to turn over every stone. Make a list of every group, club, and organization you belong to. When you're on the phone with an agent, go down that list. You'd be shocked at what you might uncover. This proactive, detective-like approach changes the entire dynamic. You're no longer a passive recipient of a price. You are an active participant in crafting that price. Every discount you uncover is a victory, a tangible reward for your diligence. And that diligence leads us directly to our fifth and perhaps most impactful strategy: understanding and mastering the invisible number that governs your rates, your credit-based insurance score. Now, this is a controversial topic, and for good reason. Many people hear this and immediately say, "What does my credit have to do with my driving?" It feels unfair, like you're being judged on something completely unrelated. But in the world of insurance, it's one of the most significant rating factors there is, right up there with your driving record and your zip code. In every state except California, Hawaii, and Massachusetts, your credit history is being used to calculate your premium. Here's the logic from the insurance industry's perspective. They aren't looking at your credit score, like the FICO score a mortgage lender uses. Instead, they use the information in your credit report to generate a separate, proprietary insurance score. They've run decades of data on millions of customers, and their actuaries have found a strong statistical correlation. People with lower insurance scores are more likely to file claims. Not just more expensive claims, but more claims in general. The industry's argument is that how you manage your finances is a reliable predictor of your overall level of responsibility, which extends to how you maintain and operate your vehicle. Whether you agree with that logic or not is irrelevant to the reality of the system. The system exists, and it is costing people money. A study by the Zebra found that drivers with poor credit pay, on average, 114% more for car insurance than drivers with excellent credit. That's more than double the price for the exact same coverage on the exact same car, for a driver with the exact same driving record. The penalty for poor credit is often more severe than the penalty for a recent at-fault accident or a DUI. It is a massive silent factor working for or against you. So what do? You take control of it. This isn't a quick fix like finding a discount, but it's a foundational strategy that will pay dividends for the rest of your life, and not just on insurance. First, you need to know where you stand. You are legally entitled to a free copy of your credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, once per year. You can get them from the official government-mandated site, annualcreditreport.com. Do not go to other sites that promise free scores but are really just trying to sell you something. Once you have your reports, go through them with a fine-tooth comb. You are looking for errors. A study by the Federal Trade Commission found that 1 in 5 consumers had an error on at least one of their credit reports. A single mistake, a late payment that wasn't late, a debt that isn't yours, an incorrect credit limit, can drag down your score and inflate your insurance premiums. If you find an error, dispute it immediately with the credit bureau. They are legally obligated to investigate and correct it. This is the single fastest way to potentially improve your score. Beyond fixing errors, you need to build good credit habits. It boils down to 3 main things. 1. Pay every single bill on time every time. Payment history is the single biggest factor in your credit score. 2. Keep your credit utilization low. This means if you have a credit card with a $10,000 limit, you should aim to keep your balance below $3,000, or 30%. High balances signal risk to lenders and by extension to insurers. 3. Don't open a bunch of new accounts all at once, but do build a long history of responsible credit use. The longer you've managed credit well, the better your score will be. Improving your credit-based insurance score is the ultimate 2-for-1 deal. The steps you take to lower your car insurance premiums are the exact same steps you take to qualify for a better mortgage rate, a lower interest rate on a car loan, or a more rewarding credit card. It's about building a foundation of financial stability. By focusing on this one, invisible number, you're not just playing the insurance game better. You're setting yourself up for a stronger financial future across the board. You're turning a hidden liability into a powerful asset. Now let's shift our focus from an invisible number to the most visible, tangible part of this entire equation: the 3,000-pound machine sitting in your driveway. This brings us to our 4th and perhaps most impactful strategy: choosing the right car. Most people think the price of a car is the sticker price plus financing. They are dangerously wrong. The true cost of owning a vehicle includes fuel, maintenance, and a massive, often overlooked component: insurance. The specific make, model, and year of your car can swing your annual premium by not just hundreds, but potentially thousands of dollars. It's a decision that has financial consequences every single month for as long as you own it. To understand why, let's step into the shoes of an insurance underwriter. Their job is to predict the future cost of a claim. And when they look at your car, they're not seeing a symbol of freedom or a work of art. They're seeing a collection of parts with a price tag. Let's imagine 2 drivers, both with identical driving records and credit scores. Our first driver, Alex, Just bought a brand new high-performance European luxury sedan. It's gorgeous. It has state-of-the-art laser headlights, a carbon fiber roof, and an infotainment system more complex than a space shuttle. Our second driver, Ben, bought a 5-year-old top-selling Japanese sedan. It's reliable, safe, and frankly a little boring. One day, both Alex and Ben have the exact same minor accident. A careless driver backs into them in a parking lot, cracking a headlight and denting the front bumper. For Ben, this is an annoyance. A new bumper cover and a standard halogen headlight assembly are readily available. A local body shop can source the parts and complete the repair for, let's say, $2,000. The insurance company cuts the check. But for Alex, it's a catastrophe. That single laser headlight isn't just a bulb. It's a sealed, computer-controlled unit that costs $4,000 to replace. The bumper isn't just plastic. It's molded around a dozen sensors for the adaptive cruise control and parking assist systems. Replacing it and crucially recalibrating all those sensors adds another $5,000 to the bill. Alex's minor accident just became a $9,000 claim. The insurance company sees this risk before the accident ever happens. They know that every part on Alex's car is exponentially more expensive to repair or replace. So, his premium isn't just a little higher than Ben's, it's astronomically higher. He's paying a luxury tax, not at the dealership, but every 6 months on his insurance bill. But it gets even more complicated. This leads us to what I call the safety paradox. We're all told to buy the safest car we can afford, and for good reason. Cars with 5-star crash ratings and designations like the IIHS Top Safety Pick Plus are incredibly effective at protecting you and your family in a serious collision. And yes, from the insurance company's perspective, this is a good thing. It lowers the potential for massive payouts on the medical payments and personal injury protection portions of your policy. But here's the paradox. The very technology that makes these cars so safe in a high-speed crash often makes them extraordinarily expensive to fix after a low-speed fender bender. That windshield isn't just a piece of glass anymore. It has a camera and a LiDAR unit embedded in it for the lane keeping assist and automatic emergency braking systems. A simple rock chip that spiders into a crack used to be a $300 replacement. Now on a modern car, it can be a $1,500 job because the new windshield's camera system has to be professionally recalibrated by a technician with specialized equipment. That side mirror? It doesn't just hold a piece of reflective glass. It has a blind spot monitoring light, a heating element, a motor to fold it, and sometimes even a camera. A teenager clipping it on a bicycle can result in a $1,000 repair. So while you are safer, the insurer's risk for collision claims, the most common type of claim, goes through the roof. The safer the car is for you, the riskier it can be for their wallet in everyday situations. Then there's the third factor, theft. Insurance companies have access to mountains of data on which cars are targeted by thieves. They know, down to the specific model and trim level, which vehicles are most likely to be stolen. This data comes from organizations like the Highway Loss Data Institute, and it directly impacts the comprehensive portion of your premium. If you're considering buying a car that's consistently on the most stolen list, whether it's a popular full-size truck, a muscle car with a powerful engine, or a model with a known security vulnerability, you will pay a penalty. The insurer knows there's a higher than average chance they'll have to write a check for the full value of your car, and they price your policy accordingly. A 5-minute search for a car's theft rate before you buy it can literally save you hundreds of dollars a year. So how do you turn this knowledge into power? You use the single most important car buying hack that almost no one does. You get an insurance quote before you buy the car. Let me say that again. You get a real live insurance quote before you sign a single piece of paper at the dealership. Imagine you're at the end of a long car search. You've narrowed it down to 2 vehicles. Car A is a sporty, stylish crossover that you've fallen in love with. Car B is a slightly more practical, less exciting sedan. They're roughly the same price. You're leaning heavily toward the crossover. But you stop. You take out your phone, you pull up the vehicle identification numbers or VINs from the online listings for both cars, and you call your insurance agent or use their online quoting tool. You spend 15 minutes getting a quote for both vehicles. The results are stunning. The sporty crossover, Car A, with its more complex parts and slightly higher theft profile, comes back with a premium of $250 a month. The boring sedan, Car B, comes back at $170. That's an $80 a month difference. It doesn't sound like a fortune, but let's do the math. That's $960 a year. If you plan to own the car for 5 years, you will pay an extra $4,000, $800 just in insurance premiums to drive the crossover. Suddenly, the true cost of that stylish car is almost $5,000 more than you thought. Is the extra style worth the price of a luxury vacation? Or a significant contribution to your retirement account? This single 15-minute phone call can reframe your entire purchasing decision. It moves insurance from an afterthought to a critical factor in your financial calculation. It's the ultimate power move for a car buyer, allowing you to see the invisible price tag attached to every car on the lot. Your choice of vehicle is a massive lever. Don't just think about the monthly car payment, think about the monthly insurance payment that comes with it. Choosing a car that is popular, has readily available parts, is not a major theft target, and has a good balance of safety and repairability is a foundational step to securing lower rates for years to come. You've now learned how to weaponize your driving record, master your credit score, and choose the right vehicle. You've addressed 3 of the biggest factors in the entire insurance puzzle. But what if I told you that even with a perfect car and a spotless record, you could still be overpaying by 50% or more? The final strategy we're about to cover is the one that ties everything together. It's the master key that can unlock the absolute lowest rates possible, regardless of your situation. It's not just about playing the game better. It's about changing the rules of the game in your favor. It's the one thing that puts all the power and all the savings squarely back in your hands. And that brings us to the 5th and final strategy, the single most powerful action you can take to guarantee you're paying the lowest possible price for your auto insurance. This is the master key that unlocks all the other savings. It's the one thing that insurance companies hope you never ever do. And that is, you must force them to compete for your business. Annually, without fail. Let me be crystal clear. The single biggest mistake a consumer can make in the world of auto insurance is being loyal. I know that sounds completely counterintuitive. We're taught that loyalty is a virtue, that companies reward it. But in this industry, loyalty is often penalized. There's a quiet practice in the insurance world known as price optimization. It sounds harmless, but here's what it means. Insurance companies use sophisticated data analysis to figure out which customers are least likely to shop around for a better rate. And once they've identified you as a sticky customer, someone who is likely to stay put no matter what, they can slowly, incrementally, raise your rates year after year. It might be just a few dollars each renewal, so small you barely notice. But over 3, 5, or 10 years, you could be paying hundreds, even thousands of dollars more than a new customer with the exact same driving profile. They are banking on your inertia. They are profiting from your loyalty. The so-called loyalty discount they might advertise is often just a small token to keep you from looking, while the underlying rate has been creeping up for years. The only antidote to this loyalty penalty is to become a disloyal, savvy shopper. So how do you do it? How do you turn the tables and make these giants fight over you? It's a 3-step process. Prepare, compare, and confront. First, prepare. This is the easiest part. You need to gather your arsenal before you go into battle. This means getting a copy of your current policy's declarations page. This is the holy grail. It's the 1 or 2-page summary that lists all your coverages, your limits, your deductibles, and what you're paying for each. You cannot shop effectively without it because you need to compare apples to apples. If you get a quote from another company for $50,000 of liability coverage, you need to know if you currently have $100,000. Otherwise, the comparison is meaningless. You'll also need the basics: your driver's license number, the vehicle identification number or VIN for each car, and the date of birth for every driver on your policy. Get this information together in one place. It will take you 10 minutes, and it will save you hours of frustration. Second, compare. This is where the magic happens. Your goal is to get at least 3 to 5 competing quotes. There are a few ways to do this. The old-fashioned way is to call individual insurance companies one by one. You can call Geico, then Progressive, then State Farm. This works, but it's incredibly time-consuming. A much better approach is to use a force multiplier. You have 2 great options here: independent insurance agents and online comparison websites. An independent agent is a licensed professional who works with multiple insurance companies, not just one. They work for you, not the insurance company. You give them your information once, and they do the shopping for you across their network of carriers, which can include companies you've never even heard of. They can provide expert advice, help you understand the differences in coverage, and find discounts you might miss on your own. This is a fantastic option if you value personalized service and expert guidance. The other option, which is the fastest, is to use an online insurance comparison tool. These websites let you fill out one form with your information, and within minutes, they provide you with quotes from a dozen or more different insurers. It's the digital equivalent of what an independent agent does. The key here is to use reputable sites and to be prepared for some follow-up emails or calls. But the sheer speed and breadth of comparison you can achieve in under 30 minutes is a complete game changer. You can go from being in the dark to having a crystal clear picture of the entire market landscape for your specific profile. You'll instantly see if your current insurer is competitive, or if they're taking you for a ride. Now for the final crucial step: confront. Once you have those new lower quotes in hand, your work isn't done. Your first call should not be to the new company to switch. Your first call should be to your current insurance company. This is the moment of truth. You call their customer service or retention department, and you say something very simple and polite, but firm. Hello, my policy is up for renewal soon. I've been a customer for X years and I've been very happy. However, I've done some comparison shopping, and I have a quote from another reputable company for the exact same coverage for X dollars less. I would prefer to stay with you, so I'm calling to see if you can match that price. And then you stop talking. The silence that follows is where you reclaim your power. In that moment, the script has flipped. You are no longer a passive price taker. You are a valuable asset they are about to lose. You'll be amazed at how often they will suddenly discover a new discount you're eligible for, or find a way to re-rate your policy to bring the price down. They have internal levers to pull to keep good customers, but they will almost never pull them unless you force their hand. If they can match or beat the price, fantastic. You just saved yourself hundreds of dollars with a 10-minute phone call. If they can't or won't, then you respond with equal politeness. I understand. Thank you for your time. Please tell me the process for canceling my policy, as I will be switching to the new carrier. You must be willing to walk away. Your leverage is only real if you're prepared to use it. Switching is not nearly as difficult as they want you to think it is. The new company will handle most of the paperwork. This process, prepare, compare, confront, should be your annual financial ritual. Mark it on your calendar 1 month before your policy renews. It is, without a doubt, the #1 way to keep your auto insurance costs at rock bottom forever. So let's bring it all together. We've covered 5 powerful, proven strategies. 1. You will clean up your inputs. That means actively managing your driving record to avoid tickets and accidents, and protecting your credit score as if it were cash, because it is. 2. You will optimize your policy. You'll raise your deductibles to a level you can comfortably afford, dropping coverages like collision and comprehensive on older, low-value cars, and ensuring you have enough liability coverage to protect your assets, but not so much that you're overpaying. 3. You will become a discount master. You'll go through your policy line by line, asking about every single possible discount, from safe driver and good student to bundling, anti-theft devices, and low-mileage programs. 4. You will think like an insurer before you buy. You'll check the insurance costs of a car before you fall in love with it on the lot, understanding that the sticker price is just the down payment on the total cost of ownership. And finally, 5. You will abandon false loyalty and embrace competition. Every single year, you will make insurance companies fight for the privilege of having you as a customer, putting the power and the savings right back where they belong, in your pocket. Look, the money you save here isn't just numbers on a screen. An extra $400, $600, or even $1,000 a year is not trivial. That is a vacation. That is debt paid down. That is an investment in your retirement account. That is peace of mind. Taking control of this one major expense is a skill, and it's a skill that pays you back every single month. You now have the complete playbook. You know more about how this system works than 99% of drivers on the road. The only thing left is to take action. Don't just watch this video and say, "That was interesting." Pull out your policy declarations page right now. Go to a comparison site. Make the call. The power has been in their hands for far too long. Now it's in yours. You are officially in the driver's seat. Go get the rate you deserve.